Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about inventory and housing demand. As always, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here. I'm in Houston, Texas, about to speak at an event in a few hours. So I'm dressed in the event's colors for today.
Yes, very dapper today, as per usual. Okay, well, so what a weird week because we don't have jobs report again. Just when you got it back, now it's gone again.
Yes, we were going to do a jobs week preview today, but because of the shutdown, that things have been delayed. We do have some, ADP and some private sector labor reports we can go off of, but kind of the big ones, job openings and the BLS Jobs Friday report are the things that really drive Fed policy. So we're going to have to wait for that. But we had a weekend tracker that was kind of stunned me to a degree. And we're in February, so we're getting ready for spring. So I think the topic is, are we going to have some weeks this year that our tracker data has negative year-over-year inventory?
That is so interesting. Okay, so what was it about the tracker data that stunned you?
Well, we have a huge snowstorm, and our weekly data is very prone to being hit by either a holiday or some kind of weather-impacted event. However, the weekly pending sales were still positive. I mean, I could say that, it could have been more positive, but I was anticipating a decline in the weekly pending sales data. The purchase application data, I had expected a decline. By the time this podcast comes out, we're going to get the freshest data out there, but we have only had a 0.4% decline week to week, up 18% year over year. So the spring demand is going well, and again, we're near 6%. Even with the 10-year yield is, close to 4.30 right now. The highs that we see last September, spreads got a little bit better, but the demand curve is good enough to where the growth rate of inventory has slowed, starting from when the housing market shifts there? Mid-June. And because that has slowed, the slope of this curve might not be strong enough for a few weeks right now that we might have negative year-over-year inventory. The last time this happened was actually in 2023. When mortgage rates did get to 5.99%, we had one real big sales print in February of 2023, got almost 500,000 more home sales. And then, back then I used to write, okay, that was the peak of sales for this year. I did the same thing in 2024. And then home sales started to slowly go down, but the growth rate of inventory just couldn't compete with the year-over-year comps. So we might be in that situation this year where the year-over-year comps last year were really strong. It was really good. Remember how happy I was for the inventory growth last year? I was like, this is great. But because we're dealing with harder comps, and if rates stay lower for longer, we might have some negative year-over-year prints on our weekly inventory data.
So, as someone who was right in the middle of that giant snowstorm, I can tell you that it fully shut down streets here in the Dallas area for 4 days. And some streets, my street wasn't fully open for 7 days, 6 or 7 days. And that snowstorm impacted 2/3 of the country, population, 2/3 of the country. So it's pretty crazy.
I'm like, man, I really was anticipating. Now, inventory fell a little bit and new listings data fell a little bit, but on the seasonal data line, that looks somewhat normal. But still, I was a little bit surprised how well demand held up, which makes me think that demand might have been better if everything was sunny and there's no snow around the country. And eventually in time, snow goes away, we get back to normal. It all works itself out at the end. But the tracker for the month of January just kind of reaffirmed what we've always talked about since November of 2022, that when the forward-looking data gets better and you get about 12 weeks, and right now, every week in the tracker has been positive, The supply and demand equilibrium changes. So the growth rate of inventory doesn't have like what it did last year. Like last year, mortgage rates were still above 7%. And the housing market just doesn't operate well with 7% plus mortgage. But late 2022, early 2023, mid 2024, mid 2025, and now early, we got four. Now we have four. It's above a Trinity trend here. The data just looks a little bit different. So inventory is still up year over year, but at 9.65%, we were running at 33%. So if it does occur that inventory is negative, put kind of more weight on the comps are really hard and rates are lower, right? And it's still going to be a very healthy year in terms of inventory levels. We're nowhere near the unhealthy and savagely unhealthy levels that we saw in 2021, 2020, and early 2022. So all positive in the sense of creating a balanced buyer and seller marketplace across the country, but also mortgage rates are near 6%. And this has worked 4 different times.
You always talk about demand picking up when mortgage rates just get to 6% and, of course, lower. Makes total sense. And then sometimes I ask you about what about those sideline buyers? So let me ask you this question. When you look at demand right now, what would tell you that like it's more than the normal demand as far as like maybe we're getting some of those missing buyers over the last couple of years when we're like a million down over the last couple of years?
So sales aren't booming. They're just growing slightly from a very, very low base. If I saw existing home sales get above 4.71 million, then we're back to kind of what we saw in the last decade. Like 4.71 to 5.3 million, that's very doable in the last decade. Of course, housing was a lot more affordable back then, and we have a lot more inventory back then. But all I'm seeing is a bounce from a very, very low base. Affordability got a little bit better on its own by just price growth cooling down and wages rising, and now rates went lower. So for now, just look at it, because when housing takes off, it looks like COVID. Remember COVID, we're like, oh, housing's going to be back in 6 to 8 weeks. And people were like, oh, wait, we're going into a depression. Nobody's going to buy. And then it was 6 to 8 weeks was the sharpest recovery in housing demand in the history of America. And what we saw was like 27 and 33% year over year growth. And we were just flying through the numbers because it was a V-shaped recovery. Right now, all I see is kind of a little bit of growth from a very low base. If mortgage rates got below 5.75 and headed lower, I'd have a much different take about housing. I just can't get there with neutral policy being around 3 or 3.25. It's hard to get the 10-year yield below 380. I mean, we're sitting right here. It's like 428. We're at monthly highs in the 10-year yield right now. So as long as neutral policy is here and the labor market isn't breaking, this is kind of the low level that we should kind of expect until something changes out there. But it is interesting to me that our tracker looks the same when we get rates near 6%. The demand curve looks a little bit better. The growth rate of inventory tends to slow down. But again, I want to get people into the realm of, we used to have a time where we have rising sales, rising inventory, rising prices. That used to be the norm in previous decades. And because we're working off of such low base, we can have that again. And that's what we're seeing this year. Inventory is up year over year. New listings data is up year over year. This last week it was down a little bit. Purchase application data is up week to week mostly, and year over year every week, double digits. Rates are near 6%. So a healthier housing market. So if there are some weeks that inventory is negative year over year, just remember we have very, very hard comp. We were up 33% at one point last year. We had a lot of sellers that want to be buyers, but some of them didn't get what they wanted, so they just pulled their house back, much like they did 2022, right? And 2022, right. We saw new listings data decline, so people took their homes on the market. And then when rates were better, just remember, supply is a function of demand in housing. That seller, 70 to 80% of the time, is a buyer. So the hypothetical sellers buyers market, just remember, a seller is going to be a buyer. So that is, it's not so clear cut when people say it's a seller's or buyer's market, because that seller's also needing to sell, and he or she then becomes a buyer right after that, or getting ready for the process to put an offer as well.
So I had Mike Simonson on yesterday, your friend Mike, our friend Mike, and he talked about echoing some of these same things. And his takeaway was like, listen, it looks like a positive going into spring, but it's not like anybody thinks it's going to be blockbuster, right? Unless mortgage rates actually drop pretty, into the fives in a way that like spurs that. But otherwise, we're just looking at just trying to get back to normal.
Trying to get back to normal, but I mean, just a little bit of growth. We've never had growth in home sales, existing home sales, the last few years. We've had flows of data, right? When I talk about flows of data, rates get near 6%, demand picks up, then rates shoot up past 7%, right. Demand slows down. We do this back and forth on here, and that changes the data for us as well. But another interesting aspect of the tracker is our price cut percentage. For the first time in a while, is now negative year over year. So even with inventory growth picking up, the price cut percentage went a little bit below last year's levels because demand is picking up. And this is the thing that I've always tried. There is a supply and demand equilibrium. Everyone always likes to talk about supply so much. We've literally had supply rise for years, right? But it's only when rates get near 6% that the demand picks up, and we just kind of work off of that. So that's why the tracker to me is very, very prolific. It's very, very nitty gritty. It gets to, all the crooks and nannies, if you're trying to like brush your teeth perfectly. And it looks forward out here, right? These pending contracts, 30 or 60 days going to existing. So you're already looking February, March, and April kind of mindset. And so far, so good. And I think to me, the one key variable is rates didn't go above 7%. Right? A lot of people thought, okay, if Fed's going to cut rates at the end of the year in 2025, rates are going to go back at 7% because it didn't happen this time because the labor market was much different this time. And we're entering a new area where we're going to get a new Fed chairman and all this stuff. But I'm not so convinced on the mortgage rates breaking so much lower than some people think. I'm a little bit more bullish on the economy going into this year. This is why we had 6.75 as the high end. This is why the 10-year yield can get to 440 or 460 if the labor data starts to improve out there. So, and then we work off and see how the housing market reacts to that. But for now, not bad. Because I was anticipating weekly pending sales down, purchase application with the week to week having more aggressive hit and everything, and just staying down near 6. See, there's no volatility, right? We have all these crazy headlines, and mortgage rates barely budged for like 8-9 days out here, and we're at monthly highs on the 10-year yield. And that's why I always say when the mortgage-backed security, announcement came, I thought that was more of a defensive move than an offensive move. Because if the economy starts to pick up, you don't really can justify the 10-year yield below 4% or rates going much lower because we're fighting to get to neutral policy, not accommodative, right? Just a neutral policy.
Speaking of policy, since the last time that you and I were on the podcast, you were on, was it ABC News, CBS? What was it?
ABC, yes.
ABC, sorry. So you're on ABC News, a national audience, and they wanted to talk all about Kevin Warsh and what you thought this Fed was going to do, which I thought was really interesting for that larger consumer audience. I think at this point, the Fed drama has gotten into the mainstream.
It is. I have a lot of thoughts on Kevin Warsh and a lot of thoughts on what might be happening here, maybe for another time, but it's not shocking to me that the 10-year yield didn't go much lower because of him. Kevin Warsh is talking about reducing the balance sheet and maybe getting short-term rates, and they're doing some regulations. And I've always thought he had a weird take on QE and inequality and all that stuff. And he's always very hawkish when a Democrat is in the White House, but when Trump's in the White House, all of a sudden he changes his tune. So it'll be interesting to see, because it looks like to me they want to somehow change regulations and reduce the balance sheet and then maybe get short-term rates lower. Some people would say that's might raise the 10-year yield up higher, or might get mortgage rates up. But always remember what the Trinity impact of our policy or theory was about the Trump's White House. He needs a lower dollar, he needs lower oil prices, and he needs lower rates. But he's always talked about lower rates, about the interest paid on the budget. And if they cut rates more, the dollar can get stay weaker or easily below 100. So there might be some other game plans here with Myron and Hassett and Warsh in the White House that might not relate to housing. We'll cross that bridge when we get there. But for now, that mortgage-backed security rate, even though it's only 10 to 20 basis points difference, defensive mechanism, right? On days when yields go up, spreads get a little bit better, it limits the damage here and it keeps us near 6%. So for now, the month of January, the tracker looked good. Just continuing what we saw the second half of 2025. Take the last 2 weeks, Christmas, New Year's, and the first week of the week out of the equation. The next existing home sales report might be a little bit lower just because of that. And then we just take it off from there. So very, very happy. I could not have asked for a better start of the year with this, but I am surprised that demand held up considering so much of the country was in a snowstorm.
Absolutely. Logan, thank you so much for being on. We will see you in a couple of days now, next week at the Housing Economic Summit here in Dallas. It's going to be amazing.
Talk about timing. Talk about having all that talent into one event in one day and all these different takes. Barry Habib's going to be
at this time.
Simonson, Odetta Cushy, Dr. Laus from the NAR. We have a host of people. There's a lot of people speaking. So I think it's good because we've got enough data now. We always said by February, you get a good idea of what's going, but what gets you there, right? And I think the big difference now, the big difference since the second half of 2025 is rates are near 6%. It's so far, it's not shot above 7. Spreads are normal. Hug a mortgage spread, take a selfie with it. It's all about the spreads, all positive.
All positive. Logan, thank you so much. Talk again soon.
Pleasure.